When a company wants to go public, they can file for an IPO, but there is another path they can take. There is something called the dual track process. In a dual track process, a company has filed for an IPO and is actively looking for a potential buyer. In a typical IPO process, a company hires one set of bankers and advisors to take them public and raise additional funding. In a dual track process, a company will hire two sets of advisors, one set to potentially take them public and the other set to help actively look for a potential buyer. A company may choose the dual track process both as a form of insurance and as a way of having more negotiating power. By having a potential IPO price, it can then go to a buyer and say, this is how much I could be worth. A dual track process can also be attractive in times of market volatility. When a company doesn't get the IPO price that they were hoping for, they then have another path to secure the valuation that they were perhaps expecting. Historically, it's been the private equity-backed companies that have been considering the dual track process. But increasingly, we're seeing tech companies and those backed by venture capitalists also going by that route. For example, in 2018, German software giant SAP acquired Qualtrics for a price tag of about $7 billion. Previously, Qualtrics had been seeking an IPO with a valuation around $5 billion. So in this particular case, Qualtrics was likely able to leverage its IPO price into a higher acquisition price. There are some potential drawbacks to the dual track process. A, it can be more costly and time-consuming. B, it could ruffle feathers among the public investing community who may have been seriously considering buying into shares of the company, but at the 11th hour see the IPO pulled.